I'm Paul DeNoon, Director of Emerging Market Debt at AllianceBernstein and Portfolio Manager for the AllianceBernstein Global High Yield Portfolio. I'd like to provide a brief update on the developments in the global economies, bond markets, and the portfolio. I'll also share with you some perspective on where we see opportunities today. The VIX index, which measures the implied volatility in the options market and U.S. equities, has been rising, hurting some sectors of the fixed income market. Over the past few weeks, yield spreads have widened about 25 basis points in both high yield and emerging market debt. Not an alarming correction after very impressive performance during the first 9 months of the year. Spreads on investment-grade corporate bonds are largely unchanged over the same period. Many observers seem to link higher equity volatility and widening credit spreads to concerns about global economic growth, but we find this explanation difficult to understand. Recent economic data has exceeded most forecasts, and many economists have raised their GDP forecasts for 2009 and 2010. We share investors' concerns about high unemployment rates in many countries, but believe that jobs will become available as confidence in a permanent recovery in demand grows. It's important to look past the narrow U.S.-centric view of some forecasters and look to the powerful trends in domestic consumption in emerging economies such as China, Brazil, India, and Korea. We don't believe in the new normal of slower economic growth. Instead, we see a new mix of economic growth. We agree that U.S. consumer spending growth will slow, but we believe that it will be likely replaced with more investment growth in the U.S. and an increase in domestic demand in many emerging economies. In our recent study of global consumption, we found that global consumption rose 3.3% from 2006 to 2008. 1.8% came from developed economies, and a remarkable 1.5% came from emerging market countries. Emerging markets are making a much bigger contribution than during the 1990s, when they only contributed 0.6% of the 2.8% growth in global consumption. These facts are being largely ignored by those who argue for the new normal. The bottom line is that despite the uncertainty that remains, in our view, underlying global economic fundamentals are sound, and combined with attractive valuations, they justify continued exposure to credit-sensitive sectors like investment-grade corporate bonds, high-yield debt, emerging market debt, and commercial mortgage-backed securities. There is also an enormous amount of cash remaining in the hands of individual investors, institutional investors, and corporations that's yielding very little, so we believe there's lots of incentive to invest in higher risk assets. This creates a lot of opportunity for global high yield portfolio. We've designed the portfolio to pursue high current income and overall total return while reducing risk by investing across different bond sectors and geographies. For example, high yield spreads on U.S. high yield bonds versus U.S. Treasuries are still above their long-term averages and at levels last seen when WorldCom declared bankruptcy. Of course, these investments aren't without risk, and it's important that investors understand this. High yield and emerging market bonds can be volatile. That's why they offer higher yields. Our goal is to find the bonds that offer attractive long-term potential based on the risk they carry. That's how we pursue the portfolio's investment objective. Investing in global high yield means looking past negative headlines and anxiety to focus on identifying real opportunities. That's what we continue to do for the investors in the AllianceBernstein Global High Yield Portfolio. Thank you.